Hi, and welcome to this session on investment essentials. Today, we'll touch on quite a few things, including the value of an investment policy specific to your credit union, responsibilities of the Board and Asset Liability Management Committee, or ALCO, investment portfolio risks, permissible investments for credit unions, and finally, important points to consider when managing your institution's investment portfolio. At the financial level, credit unions focus a lot on loan growth, deposit rates, and expenses. But the investment portfolio is another critical factor to consider. In times of higher liquidity, which is caused by either decreased loan demand or higher levels of deposit growth, many credit unions find themselves managing more cash than usual and either neglect the effective management of these funds or try to reach for yield and ignore the risks inherent in the investment portfolio. For some credit unions, something as easy as managing overnight cash in a variety of overnight accounts could be done effectively to increase yield while still maintaining a strong liquidity profile. For others, purchasing investments that are longer term than just 90 days means that they will have to manage an investment portfolio which entails a variety of risks that need to be understood, managed, and constantly monitored. What some may not realize about the investment portfolio is that it can be a significant source of income for the credit union. But before you can leverage the value of your investment portfolio, you first need to make sure you have all the necessary components. The first is an adequate investment policy. The purpose of the investment policy is to set forth operating procedures to guide administration of the credit union's investment portfolio. This means explicitly stating which types of investments are permissible and which are not, investment limits, which reports are to be supplied to the board each month, etc. It should also ensure investment activities are conducted within applicable state and federal laws and regulations, including those specified by the NCUA. The size and complexity of the credit union, as well as its investment portfolio, typically determines the complexity of the investment policy. That means not all policies are the same, and the one your credit union develops should address your specific investment philosophy and risk tolerances. Of course, the policy should be approved by the board of directors and followed by management when implementing investment activity. This policy should be reviewed and approved by the board annually, adjusting risk parameters that stay within the risk profile of the credit union while still giving management the flexibility to manage an effective investment portfolio. As mentioned, not all policies are created equal. Each credit union will have different ideas of what their investment portfolio should look like. For example, a credit union already originating mortgage loans might be more comfortable buying mortgage-backed securities than a smaller, less complex credit union. Also, it needs to be understood that each credit union has different philosophies, risk tolerances, liquidity levels, staff resources, and so on, all of which the policy should list out. The Board of Directors plays a large role in overseeing the investment policy and portfolio. In fact, it's their job to maintain general supervision of all investment activities. To do this, they typically establish and designate an Asset Liability Committee, more often referred to as the ALCO. The ALCO then becomes the main body in charge of the developing investment strategies under controls established by the board. It's usually comprised of select members of the board, one of whom is the treasurer. Other members of the ALCO could include staff positions such as president or CEO, CFO, credit officer, and select staff who have an impact on balance sheet strategies. The chairperson of the ALCO is typically the board treasurer. The committee has a task of formulating and approving the strategies used to accomplish the stated investment objectives. The committee should appoint one or more staff persons to be responsible for implementing these strategies within the constraints of the investment policies. Another responsibility of the board and ALCO are to periodically review investment reports, usually at each monthly meeting. Reports could include cash flows and liquidity projections, interest rate risk compliance tests, the impact to net economic value as interest rates shift, book versus market value of all holdings, competitiveness of deposit rates, balance sheet trends, borrowed assets and member liabilities, and portfolio results compared to budgeted projections. As these reports are discussed, it's important that the ALCO keep a record of minutes. That way, the credit union can be sure of what strategies and risks have been addressed. Now let's talk about risk in your investment portfolio. The most important thing to remember is that no investment portfolio is ever going to be risk-free. Thinking that way won't help you because it's just not realistic. Instead, the idea is to manage risks while maintaining a profile with regard to safety, liquidity, and yield. It's true that cash is sometimes seen as risk-free, but that's not really the case. Cash must reside somewhere, right? And furthermore, the cost of not investing is also a risk. The main risk you're going to see in any portfolio is interest rate risk. This is the risk that an investment value will change due to a shift in the absolute level of interest rates. Interest rates and bond prices move in opposite directions. So, if interest rates rise, bond prices fall, and vice versa. As interest rates increase, the cost of holding a fixed-rate bond increases, since investors are able to realize greater yields by purchasing other investments that reflect the higher interest rate. For example, if a credit union buys a 5-year bond today with a rate of 3% and rates over the next year increase, investors can now get a 4-year bond at 3.5%. In this situation, the credit union will experience interest rate risk since the rate on like bonds are higher than the bond they originally purchased. This risk keeps many credit unions from investing properly because they are trying to time the market, which adds risk to their balance sheet as they may not invest their cash as effectively as they should. But interest rate risk isn't the only thing to consider when managing your portfolio. Liquidity risk is also a key factor. Liquidity risk is the degree to which an asset or security can be bought or sold in the market without affecting the asset's price. You see, liquidity is characterized by a high level of trading activity. Assets that can be easily bought or sold are known as liquid assets. U.S. Treasuries tend to be the most liquid investment, but with that liquidity, you do give up some yield. That's why most credit unions tend to buy agency securities. They have a slightly better yield and are very liquid. Liquidity is key for credit unions as it allows for the sale of bonds when repositioning your portfolio or when cash is needed to meet demand. Higher quality securities also allows the credit union to use this collateral to borrow against rather than selling bonds strictly for liquidity. Credit risk is another main risk when looking at an investment portfolio. This really only comes into play when looking at corporate and municipal bonds. Although credit unions don't typically purchase these types of investments, it's certainly as critical as interest rate or liquidity risks, and it shouldn't be overlooked when buying non-agency bonds. Don't stress too much though. All investment risks can be managed and addressed in your investment policy. That's why risk guidelines and limitations are part of the policy after all. In addition to what's written in the policy, the board and ALCO need to have complete understanding of the risks to navigate market changes that impact the investment portfolio effectively. So, now that we know the risks, the big question is, what investments are permissible for credit unions? Most institutions tend to think of their investment portfolio as just overnight cash and a group of CDs. But there are also a variety of options for cash, like higher paying overnight accounts like 30 and 90-day accounts. The goal is to manage each investment according to their unique structures so that you get the best return. When it comes to short-term investments, a credit union has a number of options for their overnight cash holdings, including your corporate credit union and the Fed. Then you have 30 or 90-day accounts, which can earn a slightly better yield than just the overnight cash, but the deposits remain very liquid. Other popular investment choices for many credit unions are certificates of deposit or CDs. These are easy to understand, carry little risk as they are federally insured, and can be used to build a nice ladder of investments. Then there are marketable securities. One type is bullet securities, where the investor gets interest payments on a periodic basis and the principal is received in full at a specific time, aka the maturity date. You can also look into amortizing securities where, again, the investor receives interest, but with the addition of principal payments on certain payment dates leading up to the maturity date. Outside of cash and CDs, a lot of credit unions buy these marketable securities or bonds. These are investments that are purchased through a broker and trade openly in the market. Marketable securities come in many forms. The most popular is U.S. Treasury securities, also known as government bills, notes, or bonds. These are obligations of the U.S. government, and investors can buy Treasury bills that have a series of 3 to 12 months and maturities of 2 to 10 years. Treasury bonds have a 30-year maturity. Few credit unions buy these types of investments, though. Even though they have a high liquidity profile, the yield is generally lower than other investment options. Credit unions that do buy marketable securities typically buy agency securities. These are government-sponsored enterprises, and the most popular are the Government National Mortgage Association, the Federal National Mortgage Association, Federal Home Loan Mortgage Corporation, and the Federal Home Loan Bank System, or FHLB. Agency bonds typically have a higher rate than treasuries, but have very similar liquidity profiles. Again, these are very popular with credit unions as well as most investors. They offer a lot of flexibility, so investors can buy regular bullet securities, where the maturity is fixed, or structured bonds like callable step-ups and mortgage-backed securities that have a little bit more structure and provide some additional yield versus a standard bullet security. Other permissible investments for credit unions that provide a nice complement to any portfolio include small business administration pools, or SBAs, municipal securities, corporate bonds, and mutual funds. These options are not found in many credit union portfolios because of their complexity, but can be used if your portfolio has a mix of other investments. These investments take more work for the investor to understand the risks, collateral makeup, prepayment characteristics, and the cash flow of variabilities. They are also more difficult to model cash flows and interest rate risk, which makes them a good choice for credit unions with an extensive portfolio and those that have the resources to analyze and manage the risks. Before we go, we wanted to leave you with a few more tips and tricks for managing your portfolio. When it comes to investing, the primary rule of thumb is to only invest credit union funds with brokers and firms that you know and trust. And when buying or selling a marketable security, it's always wise to get a second quote from another firm. This proves the pricing from the original broker is fair and correct, and might even give you some bargaining power when going back to the initial broker. It also proves to examiners and auditors that your credit union is fulfilling their fiduciary responsibility and ensuring fair market pricing for the investments they purchase. Lastly, don't just buy bonds the broker has to sell. Really utilize your investment strategies to buy investments which complement the rest of the balance sheet, provide adequate income, and incorporate a cash flow profile that meets the credit union's overall financial needs. That's all we have for today on the essentials of investment portfolios. We hope you enjoyed this session. Have a great day.